government works to restore regular reporting schedules, the delay has underscored the fragility of data-dependent decision-making during periods of administrative disruption. Together, these developments, from Reliance Global's substantial move into Zcash, to renewed institutional interest in privacy tokens, to macroeconomic uncertainty stemming from delayed federal data, paint a picture of a rapidly evolving financial environment where privacy, regulatory clarity, and adaptive strategy are becoming increasingly important themes for companies navigating the next era of digital assets and economic transformation. Solana is once again capturing market attention as its price edges toward the crucial $140 level. A point that traders across the ecosystem are watching carefully, especially as institutional demand continues to strengthen and spot Solana ETFs record another round of impressive inflows. Currently trading near $139 after a modest 1.4% gain in the last 24 hours, Sol is approaching the upper boundary of its weekly range, which has stretched from $124.09 to $144.01, even though it remains 31% down over the past month and still sits about 52% below its January all-time high of $293. Market participation on the spot side appears to be cooling slightly, with 24-hour spot volume falling 12.3% to about $4.92 billion, while derivatives activity paints a mixed picture. According to CoinGlass data, futures volume has dipped 1.17% to $18.34 billion, and open interest remains stable at $7.13 billion, indicating that traders are refraining from aggressively adding fresh positions following recent waves of volatility. Amid this backdrop, one factor continues to stand out strongly: robust institutional accumulation through spot Solana ETFs, which have now posted a remarkable 21 consecutive days of inflows. On November 25 alone, these ETFs attracted $53.08 million in net inflows, led by Bitwise's BSOL contributing $30.9 million, followed by Grayscale's GSOL adding $15.9 million, while Fidelity's FSOL and VanEck's VSOL brought in $4.8 million and $1.33 million respectively. In total, cumulative inflows have now surged to $621 million since late October, making Solana products the most consistently supported major crypto ETFs of 2025, particularly in sharp contrast to the notable outflows from Bitcoin and Ethereum vehicles during the same period. This momentum could soon intensify even more, as Franklin Templeton has filed Form 8A with the U.S. Securities and Exchange Commission to officially register its Franklin Solana ETF, the final procedural step before listing, which could place the new ETF on NYSE Arca as early as November 26. Solana co-founder Raj Gokal has described the ETF demand streak as greatly underappreciated, pointing out that these steady inflows have created a reliable underlying demand base even during downturns. Analysts at LVRG echo this sentiment, suggesting that Solana ETFs are forming a crucial support floor and contributing to a stabilizing effect as broader liquidity begins to rebuild. Technically, Solana's price chart shows the token pressing deeper into a tightening zone created by the confluence of a descending trendline drawn from October's lower highs and a rising support structure built on higher lows since mid-November. These types of price compressions typically precede sharper directional breakouts, making the ongoing consolidation phase particularly significant. The $140 region, long established as a major support and resistance battleground, is once again the level to watch. Momentum. Indicators reveal early signs that the market may be trying to shake off its recent period of weakness. The relative strength index has risen from oversold territory, forming a bullish divergence that often precedes relief rallies, while the MACD indicator and several shorter-term moving averages have started curling upward, signaling an early shift in short-term trend strength. Longer-term moving averages remain above current price levels, suggesting that Solana is still operating within a broader downward structure but may be laying the groundwork for a potential reversal if demand continues to build. If Solana successfully reclaims and sustains levels above $140, traders will likely target the $150 area next, and a stronger continuation could push it toward the $160 region, where more substantial resistance lies. However, failure to maintain support above $140 could pull SOL back into the $128 to $130 zone, an area that has repeatedly acted as a near-term buffer during pullbacks. A deeper breakdown below these mid-range levels might reopen the path toward the $118 to $120 support zone, especially if investor sentiment sours or if ETF inflows begin to slow. For now, market participants appear cautiously optimistic, watching whether institutional accumulation through ETFs will continue serving as a powerful stabilizing force that could help Solana regain lost ground and potentially fuel a breakout as it confronts the $140 threshold once again. German telecommunications operator 1&1 has taken a decisive step toward strengthening its position within Germany's highly competitive fixed line and mobile infrastructure market by announcing a €1.3 billion agreement to acquire Versatel, a major fiber network operator whose assets have become increasingly important in supporting both enterprise and mobile backhaul demands across the country. This acquisition marks a pivotal moment not only for 1&1 but also for their broader German telecom industry, as it represents one of the most significant consolidations in the nation's digital infrastructure landscape in recent years. The deal includes all of Versatel's assets, operations, and liabilities, including a substantial €950 million loan that the company previously owed to its parent company, United Internet. Although this loan remains with Versatel, it is backed by a 1&1 guarantee, meaning the purchase does not require immediate cash outflow, thereby allowing 1&1 to secure the acquisition in a strategically advantageous manner without placing pressure on its short-term liquidity. Additionally, the purchase price could be adjusted by up to €300 million depending on Versatel's financial performance between 2027 and 2029, with any final reconciliation scheduled for 2030, reflecting a performance-based structure that aligns incentives across both companies during the transition period. Versatel's network growth has been significant and reflects the long-term investment strategy that United Internet pursued since acquiring full control in 2014. At that time, Versatel managed approximately 37,000 kilometers of fiber spread across 226 cities, but through consistent expansion, targeted upgrades, and new deployments, the company has grown its footprint to 67,000 kilometers, covering 350 cities, creating one of Germany's most extensive independent fiber backbones. Today, this network connects more than 27,700 sites, supporting a diverse range of institutional clients, corporate customers, and Wholesale telecom operators who rely on Versatel's infrastructure for high bandwidth, low latency data transmission across urban and industrial regions. For 1&1, gaining access to this network represents a transformational step forward, particularly as the company continues its evolution as Germany's fourth facilities-based mobile provider. Earlier this year, 1&1 successfully migrated its 12 million customers to its new Open RAN mobile network, making it the first European operator to fully adopt a cloud-native, software-based mobile architecture on such a large scale. Integrating Versatel's fiber network with its mobile infrastructure is expected to yield major efficiency improvements, especially in terms of reducing reliance on competitors' backhaul systems, improving network speed and reliability, and enabling more flexible scaling as data consumption increases across the country. Industry analysts have highlighted that this acquisition places 1&1 in an increasingly competitive position within the rapidly expanding German fiber market, which has seen a surge in deployment activity after years of lagging behind other European nations like Spain, France, and Sweden. The shift toward high-speed fiber connections has accelerated dramatically, driven by growing demand for gigabit services, remote work patterns, cloud-based enterprise operations, and the nationwide transition toward digital public services. In this context, controlling both mobile and fixed-line infrastructure enables 1&1 to compete more directly with major incumbents such as Deutsche Telekom and Vodafone, both of which have invested heavily in expanding their fiber networks and modernizing their mobile backhaul systems. Beyond competition, this acquisition reflects a broader industry trend in which telecom operators increasingly recognize the importance of owning and tightly managing the infrastructure that underpins their service portfolios. With data usage skyrocketing and edge computing, 5G, AI-driven services, and IoT deployments becoming more integral to national digital strategies, the ability to control fiber backhaul and core network routing has turned into a strategic asset rather than merely a supporting function. By acquiring Versatel, 1&1 positions itself to deliver a more vertically integrated set of services, offering improved performance to consumers, enterprises, and wholesale clients alike. Versatel's strong B2B portfolio further enhances this potential, granting 1&1 access to enterprise connectivity contracts, corporate clients, and high-value data solutions that supplement its consumer-focused mobile and broadband offerings. While the transaction remains subject to regulatory approval, a process that will evaluate competitive impacts, national infrastructure implications, and long-term market effects, it is widely viewed as a forward-looking move that aligns with Germany's push toward accelerating fiber rollout and strengthening digital infrastructure resilience. If approved, the deal will not only expand 1&1's physical network reach but also enhance its operational flexibility, reduce long-term dependency on external infrastructure providers, and enable greater innovation in service delivery across both the retail and enterprise segments. Ultimately, this acquisition underscores 1&1's strategic ambition to become a more powerful and independent force within Germany's telecommunications market, leveraging full control over fiber, backhaul, and mobile network components to build a more robust and future-ready digital ecosystem that can support Germany's growing connectivity needs for decades to come. A senior Kremlin advisor has launched a significant policy proposal that could reshape how Russia treats its rapidly expanding cryptocurrency mining industry, calling for Bitcoin production to be formally classified as an export in the country's official trade statistics. According to the reports, Maxim Oreshkin, a top economic aide to the Kremlin, argued that Russia's mining sector generates tens of thousands of bitcoins annually, and because these digital assets frequently flow abroad or are used to settle import payments through alternative channels, they should be reflected in national export data and balance of payments reporting. Oreshkin emphasized that although Bitcoin and other mined digital assets never physically cross borders, they nonetheless exert real influence on Russia's foreign exchange markets, trade dynamics, and cross-border capital flows, and therefore must be treated with the same economic seriousness as traditional export commodities. His comments follow Russia's legalization of industrial cryptocurrency mining on November 1, 2024, which brought long-awaited regulatory clarity to an industry that had operated in a gray zone for years. Oreshkin described crypto mining as a new export item that the country currently doesn't value very well, noting that the lack of accounting for these digital flows distorts trade metrics and prevents policymakers from accurately assessing Russia's economic landscape. Industry leaders support his assessment, citing substantial output figures that illustrate the scale of Russia's mining economy. Sergei Bezdalov, head of the Industrial Mining Association, estimated that Russian miners produced about 55,000 bitcoins in 2023, and approximately 35,000 bitcoins in 2024, with the decline attributed largely to the impact of Bitcoin's quadrennial halving, which reduces mining rewards. Meanwhile, via Numeri Group CEO Oleg Ogienko said Russia's proof-of-work production in 2025 could again reach tens of thousands of bitcoins, underscoring the country's growing share of global hash power. Financially, the industry's contribution is already enormous. Mikhail Brezhnev, co-founder of mining hardware supplier 51ASIC, estimated nationwide daily mining revenue at roughly 1 billion rubles, linking this figure to both Bitcoin's market price and Russia's expanding computational capacity. Brezhnev stressed that because mined cryptocurrency can be directly used to pay for imports, bypassing traditional FX channels, it represents a real economic flow that should be incorporated into national accounting systems. In parallel with these developments, the Russian government has introduced a structured regulatory framework designed to bring order to an industry long plagued by unregistered operators and widespread power theft. Under current rules, legal entities and individual entrepreneurs must register with the Federal Tax Service to engage in mining activities, while hosting providers are required to appear in a separate registry. Household miners are exempt from registration only if their monthly electricity consumption stays below 6,000 kilowatt-hours, though they remain obligated to report all mining-related income. Corporate mining operations face a 25% tax rate, while individuals are taxed progressively between 13 and 22%, and non-residents pay a 30% rate. Despite clearer regulations, the government continues to struggle with widespread illegal and semi-legal mining operations. A recent investigation by REN TV highlighted that unregistered miners cost Russia millions of dollars each year due to stolen electricity, bypassed meters, and unpaid taxes. Many operators reportedly avoid registration to escape high energy tariffs and tax burdens, leading to substantial losses for the state budget and placing additional strain on public power grids. The report further suggested that while major industrial mining companies like Bit River and Intellian generally comply with regulations, smaller independent miners frequently turn to methods such as meter tampering, bribery, and covert arrangements with utility workers to maintain operations under the radar. These illegal practices result in financial burdens being passed on to households and legitimate businesses, which ultimately absorb the costs of siphoned electricity. Although Russia now formally recognizes and regulates industrial crypto mining, compliance remains inconsistent, revealing a sharp divide between large-scale institutional operators and the thousands of small miners scattered across the country. Oreshkin's proposal to classify Bitcoin mining as an export appears aimed not only at improving economic transparency but also at pressuring the industry toward fuller compliance, offering a potential mechanism for the state to better monitor revenues, track cross-border flows, and capture lost tax income. If adopted, the policy would represent a major milestone in Russia's evolving approach to digital assets, signaling that the Kremlin increasingly views cryptocurrency not merely as a speculative financial instrument but as a strategic economic resource capable of influencing trade balances, currency markets, and national revenue streams in the years ahead. Former Citadel quantitative specialists Ian Krotinsky and Ashik Dheeraj have secured $17 million in fresh venture funding to launch Fin, a stablecoin-powered payments application engineered to deliver instant, seamless cross-border money transfers, positioning the startup as a next-generation challenger to the slow and costly legacy banking infrastructure that dominates international payments today. According to the company's announcement, the fundraising round was led by Pantera Capital, one of the most prominent digital asset investment firms globally, with major contributions from Sequoia and Samsung Next, reflecting strong institutional interest in stablecoin-based financial technology. Fin aims to differentiate itself by targeting large-value transactions and global business flows, enabling users to transfer funds instantly to other Fin users, traditional bank accounts, or cryptocurrency wallets, all by leveraging stablecoins as the underlying settlement mechanism. This approach significantly reduces transfer costs and processing delays that typically accompany traditional wire transfers, especially those involving multiple currencies and conflicting financial systems. Krotinsky explained that the idea for Fin originated at Citadel, where he and Dheeraj had experimented with side projects, including a Reddit-style community platform, and encountered significant friction when trying to pay users who made it to the front page. This experience exposed the